Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer 5 of the questions that you all have sent in. Let's dive right in, see what we've got in store today. So number 1, will baby boomers crash the stock market? That's the first question we're going to tackle. Number 2, is spending dividends in retirement a better strategy than actually selling shares? Number 3, do target date funds, if you hold them in retirement, do they effectively force you to sell stocks in a down market? I'll explain that. Number 4, do bonds no longer provide diversification? And number 5, should retirees have their fixed income in a brokerage account where they can spend it? Is sort of the question there. So that's the 5th question. So let's dive right in. The first question comes from a viewer named Bart. Hey Rob, thanks for sharing your thoughts with all of us. Your humble yet thorough style is a refreshing combination. I don't know why I'm reading all that, but I'm grateful for you saying those things. Appreciate it. Here's the question. Would you have any ideas to share on this take from Reuters? Well, what are we talking about? Or Reuters, I should say, Reuters. The great boomer sell-off may overwhelm U.S. stocks. That's the big question. And here's the idea behind it. By the way, this is nothing new. We've been talking about this for 20, 30 years. The idea is that the older folks, the baby boomers, and fun fact, I am not a baby boomer. No, I'm part of the forgotten generation. Anyway, that baby boomers, they're retired, or they're in the process of retiring. 10,000 are retiring a day in the U.S. So what are they going to be doing? They're going to be selling their stocks, to live on. And then who's going to be the buyers? Well, for the most part, middle-aged folk, 40s, maybe into the 50s, are the big buyers of stocks. But if we have a lot more older folk selling stocks than we do middle-aged people buying the stocks, see that's the problem now. Won't that crater stock prices? That's the concern. That's what Reuters had talked about in that article. And it turns out, at least in my view, that the picture is a lot more muddier. I guess that's a word. Unclear than that. And I'm going to show you a couple of studies. I will link to all of this below the video. I want to show you the first one that goes back to 2011. Here it is. Again, I will link to everything in below the video. But this was from the Federal Reserve Bank of San Francisco. Let me see if I can make it a little bigger. There we go. And what they did is kind of interesting, I thought. They came up with a ratio. I don't know if they originated it, but here it is. It's this graph here. The PE ratio and the MO ratio. What in the world is that? Let me see if I can make it even a little bigger for you. Here we go. MO is the ratio between middle-aged folks, that's the M, and older folks, that's the O. And what they found, now again, this is from 2011. They said, look, there is a pretty strong correlation between the MO ratio, how many middle-aged people there are compared to older-aged folks. And I think they define middle-aged, mainly folks in their 40s versus 60s, 70s kind of range. There's a tight correlation between that and the PE ratio. And so as there are more middle-aged folks as compared to older-aged folks, and you can see the ratio here, the PE goes up. And as it goes down, the PE goes lower. And so the concern was, well, that trend is going to trickle down this way. That is, as more older people retire, right? We get that demographic shift. It's going to go down. And isn't that going to tank the PE ratio? And they even did this, the dotted line, they sort of extrapolated from 2011. And you can see that in 2025, they're predicting, now this isn't just anyone, this is Federal Reserve Bank, San Francisco, they're predicting the PE ratio will be under 10 in 2025. It turns out we actually are in 2025, so we can actually look to see how close they were. And of course, we know they weren't close at all. The PE ratio is way up here right now. And what's interesting, let me show you another article. In 2018, they sort of updated this study. So again, this is still 7 years ago, but here it is. And they pointed it out here. They said, well, this is kind of what we expected to happen. And this is 2018, here's what's happened with the PE ratio. Went in the opposite, it zigged when it was supposed to zag. And of course, they're trying to figure out why. And we know 7 years on from this study, it's continued to go up. Now, they also studied this relationship with other countries. And what they found, even discounting the last 10 to 15 years in the US, that not all countries actually exhibit a tight correlation between the aging of a population and their PE ratio, say going down, for example, as folks get older. That correlation, it was strong in the US for a while until it wasn't. It wasn't so strong in other countries. And that got us to the studies to say, okay, well, what's going on? What factors can we look at? And it turns out there's just a lot of different things that affect stock prices, far beyond just the demographics and how old the population is and versus middle age. Of course, folks look to Japan as one example, but the United States is very different than Japan. It doesn't mean that we won't follow some similar trajectory at some point, perhaps. But it's really not, I think, a fair comparison just for a lot of reasons, including the diversity of our industry and a lot of other factors. And so the short answer is no one really knows, is the short answer. Sometimes we see that, yes, as the population age, stock values go down, and sometimes they don't. I think for us in the US, perhaps a bigger issue is not the stock market valuations, but how we're going to afford things like Social Security and Medicare if we don't have more workers supporting those who are entering retirement, and what happens to our deficit and our debt. To me, certainly those could affect the stock market, but to me, those are the more direct concerns, and that's something I think, among other things, immigration and I think a sound immigration policy could positively affect those issues, but that's a whole different topic. At the end of the day, for me, I'm just sticking with a well-diversified portfolio that includes international exposure, as I've talked about many times on this channel. Again, I don't think that solves all issues, but it's, I think, as good a strategy as one can have, and just another example of why we shouldn't concentrate an entire portfolio into a single country, even one that's done as well as the United States. So at the end of the day, will the baby boomers crash the stock market? Well, one, so far they haven't. As we look at past data, sometimes that happens and sometimes it doesn't. I think the simple belief that, hey, the population is aging, therefore the market will crash, that certainly is not true. We know that. There are just too many other factors that go into the question of what a stock market is valued at and its trajectory. And of course, we can say so far, the baby boomers haven't done that. I guess time will tell. Again, I'll leave links to all of those studies below the video for those that are interested. All right. Next question. Is spending dividends in retirement better than selling shares? Here was the question. I'm struggling to grasp why selling shares is a better option than collecting a dividend in a non-retirement brokerage account. Wouldn't $2 million in SCHD, that's a Schwab dividend ETF, I actually own some shares in it, assuming a 4% yield, be better than a 4% withdrawal rate from selling VU? Given dividend irrelevance, they should be one and the same. However, in a down market, I have to imagine that a 4% yield would be better than selling 4% of a beat down asset. So this is something we've talked about a lot on the channel. So by the way, I don't think that to respond to the specific questions, selling shares is better option than collecting a dividend. That's not how I view it. I view it as total return. Total return is the dividends that I receive, as well as hopefully over the long term, increase in value. That's what I'm focused on. I don't have anything against dividends. My portfolio generates dividends. And I think particularly in a taxable account, I'm going to spend dividends first, not because there's anything special about dividends, but because having received the dividends, they're going to already be part of my taxable income. So why would I put those aside and go sell more shares that are going to trigger additional taxes if I don't have to? Now, maybe I do have to, but I'm going to start with the dividends. But again, it's not because dividends are special in any way. The problem is looking at a dividend yield on a fund like SCHD and equating it with the 4% rule. They are night and day different. Why? Remember how the 4% rule works. You take 4% of your total portfolio. Let's just assume $1 million, it's 40 grand. Then what do you do in year two? You completely throw out the 4%. It's no longer relevant. All the 4% does in the 4% rule is figure out how much you can spend in year one. And then after that, you adjust for inflation. So you ignore the 4% rule beginning in year two, take the dollar amount you spent or withdrew in year one, and simply adjust it by the rate of inflation. And that's what you continue to do throughout retirement if you follow something like the 4% rule. Now, moving to something like SCHD, that dividend yield, unlike the 4% rule, the dividend yield is changing all the time. It changes every day as the price changes. It changes over time as the companies that are in that fund, the stocks of the companies that are in that fund, either increase or decrease. And yes, sometimes dividends get decreased. They increase or decrease their dividend. And so the actual dividend yield can change all the time. What's more, if you only spend the dividend, there's no guarantee that that dollar amount will adjust for inflation, right? So the 4% you got last year could be different than the, let's just say 3.8% you get this year, if we just assume for a moment the dividend yield falls a bit, which could then be different than the year after that when the dividend yield, say, goes to 4.2%. You're not adjusting for inflation anymore. You're simply accepting whatever dividend yield and really the dollar amounts that in this case SCHD generates. If we want to ask the question, what would be better, sort of a total US stock market ETF like VTI, for example, and using that for retirement, that does pay a dividend, but not nearly as high as SCHD, versus SCHD that pays a higher dividend, which one would work out better? It comes down to one thing and one thing only, total return. Let me show you what I mean. We're going to look at Portfolio Visualizer. Here it is. I've already plugged it in. Now it only goes back 10 years because of I'm not using the paid version, but that's okay. And we can look at the two funds I put in. I use VTI and of course SCHD. I assumed $1 million portfolio, and then I set up withdrawals beginning $40,000 in year one and adjusted for inflation. And if you did that starting in 2016, with VTI today, you'd have 2.5 million. If you used SCHD, you'd have 2.1. Why? Because total return for VTI has been higher. It's compounded at a slightly higher amount. 10.3% here versus 8.44% for SCHD. That largely reflects the fact that over the last 10 years, growth stocks have outperformed value stocks, and SCHD is a value fund. Now, had value outperformed growth, it would have been reversed. SCHD would have ended up with more money in the account than VTI. VTI you could think of as a blend. So you could say, well, I think over the next 10 years, value will outperform growth, and therefore I think SCHD will do better. That's fine if that's what you believe. I don't have a strong opinion one way or another, but here's the real key. If that happens, the reason SCHD will have outperformed 10 years from now is not because of its dividend. It's because of its total return. So at least that's my take. Hopefully you find that helpful. On to question 3. Do target date funds force you to sell stocks in a down market? Here was the question. We've actually covered this, I think, in the past, but I thought it was worth revisiting. Was thinking about TDF distributions. That's just a target date retirement fund. During decumulation, wouldn't you be selling equities during a bear market? Wouldn't it be better to sell the target date fund shares and then mimic the asset allocation, I guess with specific funds, and only sell bonds during the drawdown? Or would it be an insignificant difference? It's a great question. So target date funds tend to have both stock and bond investments inside them. And so when you go to sell shares of a target date fund, you can't call up Vanguard and say, hey, I want to sell 10 shares of my target date fund, but only from the bond side, right? Stocks are down. I don't want to sell stocks. So when you give me my money, just take it out of the bonds, right? You can't do that. So if your target date fund, we'll just assume it's 50-50, 50% stocks, 50% bonds. You're going to sell 50% stocks, 50% bonds effectively when you cash in some of your shares. And so the thought is, if stocks are down 20%, I don't want to sell stocks. It's not a problem. Why is it not a problem? Well, let's imagine we move out of a target date fund for a moment, and we own 50% in a total U.S. stock fund and 50% in a bond fund, and we control it. So we could just pull money out of bonds. So let's say stocks have gone down. So in fact, our allocation has changed. Maybe we're at 60% bonds and 40% stocks because there was a big sell-off in the stock market. Maybe the baby boomers caused it. I don't know. What would we do in that situation? Well, if we're following the bucket strategy, what you tend to do is ignore the stocks, leave them alone, and just spend your bonds and your cash. But a more traditional approach is to say, well, no, when stocks are down, we don't want to ignore them. It's true we don't want to sell them, but we don't want to ignore them. We want to actually buy more of them. And so if we were to rebalance our portfolio, sell that 60% in bonds, sell 10% of that, and buy stocks with it to get us back to our 50-50, we're not selling stocks, we're actually a buyer of stocks. And that can be true even as we're withdrawing money. If we take out our money for the year and then rebalance, we get back to 50-50, we're a net buyer of stocks. And by the way, when we pull out our money, it doesn't really matter where we pull it from. It may matter from a tax perspective, but from an asset allocation perspective, it doesn't matter. Let's assume we sell stocks. So our 40% is now, 37%. But then we immediately rebalance. We're back to 50-50. We're still, even when you factor in the distribution we took, we're still a net buyer of stocks because we sold bonds to buy stocks. Now, how does that apply to a target date fund? Well, it's the exact same thing, except we don't have to rebalance. They rebalance for us. So when stocks are down 10, 20, 30%, if we have a really bad year, the target date fund is rebalancing to get back to whatever asset allocation they have. So yes, when you sell shares, it's taking it out in equal proportions to whatever the asset allocation is in that fund. Let's assume 50-50. But remember, it's already been rebalancing and will continue to rebalance. So when stocks go down, it's not selling stocks, it's selling bonds to buy stocks to bring the fund back to its stated asset allocation. So I really don't see this as an issue at all. So that's my take on it. Great question, as always. All right, number 4. Do bonds no longer provide diversification? As a longtime investor, 40 plus years, I always believed the maxim that stocks go up, bonds go down, and stocks go down, bonds go up. They'd sort of call that like a negative correlation, right? That didn't work out recently. I think they're referring to 2022, and I frankly don't understand why. It's shaken my idea of the ideal 60-40 balanced retirement portfolio. Do we now have to worry about stocks and bonds moving lower in concert rather than bonds providing counterbalance? Well, I went back to our good friend Portfolio Visualizer, and this is based on asset classes, not a specific investment, so I can get more data here. Pretty long-term series of data. And I've compared a 100% U.S. stock market portfolio with a 100% total U.S. bond portfolio. So that's an intermediate term bond fund, some government bonds, some corporate bonds, some mortgage-backed bonds. And we can look at the performance year by year. Here it is. And so the blue bar are the stocks, and the, teal, I don't know, is the bond fund. And you can see that when stocks are down, this is, 1990, stocks were down 6%, bonds were up over 8.5%. When's the next time? Oh yeah, the tech bubble crashed, so bonds did their job. They did it in 01 as well, and 02, through that whole tech bubble bursting, bonds did just what they were supposed to do. 2008, yep, bonds, would have been nice if they were up a little bit more given just how deep the loss was in stocks, but yeah, at least they did their job. Here, stocks were down, bonds were flat, so I guess that's okay. But 2022, that stands out, as a friend of mine used to say, that stands out like a fart in church. All right, what's going on? Is this the new normal? Why did this happen as opposed to what's supposed to happen like we saw back here? I think the answer is simply this. When 2022 hit, interest rates were near 0%. We'd gone, ZIRP, zero interest rate policy. We'd been at 0% or near 0% for a long time, and they started to inch up, and then we had, of course, a pretty significant inflation. The Fed's now raising rates very quickly, and we went from 0% or near 0% to whatever, 4 or 5%, very, very quickly. And I think that's why both stocks and bonds were down at the same time. Now, that is a very unusual occurrence. In fact, I would say it's a once in a century kind of event. First of all, having a 0% sort of interest rate environment is itself highly unusual. And then we had COVID, and then we had a lot of spending, a lot of government stimulus, both under, I guess, President Trump and then President Biden. And so you had a kind of a perfect storm for both stocks and bonds to take big hits in 2022. That, in my view, is what caused it. I do not think it's the kind of thing that will happen frequently. Of course, with my luck, right, it'll happen this year or next or whatever. But even if rates went up more today, the impact wouldn't be as great as it was when they went from 0 to 5%. The starting point when interest rates start to rise matters. And when you're that low and then rates start to go up, it has a big, big impact. Now, again, I'm not saying we couldn't see stocks and bonds both be down the same year. Technically, if we look back here, they were both down in 2018, although the total bond fund was only down 13 basis points, so a very small amount. So it can happen, but this kind of extreme event is highly unusual. I would put it this way: it has not changed my view of the importance of fixed income in a diversified portfolio, particularly for those of us in or near retirement. I think 2022 was an anomaly for the reasons that I described. At least that's my take on it. All right. Question 5. This is from Greg. Should retirees have fixed income in a brokerage account? I'm approaching retirement. Most of my money's in a 403B. I have 3 years worth of living expenses in a brokerage account. And he says, look, asset location says I should have stocks in my brokerage account, fixed income in my 403B, but time frame for using the money, I need it now. So what should I do? And I'm going to assume in his question that when he starts spending money, at least for these 3 years he's talking about right here, that he wants to spend it out of his brokerage account. He could spend it out of his 403B, but let's assume he doesn't want to. And that's why he's thinking, man, maybe I normally wouldn't put fixed income in a brokerage account because of the tax implications. I have to pay ordinary income tax on all the interest, but I need the money now, so maybe that's what I should do. So what are the thoughts on there? So I would give you a couple of things to think about. Number one, depending on your tax situation, municipal bonds might make sense. Now, you might not be comfortable putting your money, all of it, in municipal bonds. Of course, there are short-term municipal bonds, so they're not exposed to as much interest rate risk, but they can have more credit risk, that is the risk of default, than, say, federal U.S. government treasuries. So that may or may not be an option. Also, your tax situation may or may not make that a useful strategy, but it's something to consider. The second thing to consider is if you do have this money in a taxable brokerage account, what are the consequences for you? Yes, there's a rule of thumb that says you should keep fixed income in a retirement account, but maybe for you, the consequences won't be that severe. So I would actually, figure out in dollars, what will this do to my taxes? Depending on your age, you need to think about what will it do to ACA premium credits if you get those. If you're at that age to consider Medicare, what might the extra income do for IRMA and your increased Medicare premiums? But you might do that evaluation and conclude, yeah, it's actually not that big of a deal, right? So the rule of thumb is just that it's sort of a starting point, right? But the third thing I'll say is this. Let's imagine that for you, yeah, it really would be better to keep fixed income out of your brokerage account. And you'd prefer to have, if you could, just stock index funds, let's say. So fine, have your stock index funds in your brokerage account, have your cash or short-term, could be a T-bill ETF, wherever you want to keep that 3 years worth of money in your 403B. Then when it comes time to spend it, cash in the stocks. Now, at that, you might say, well, wait a minute, Rob. What if stocks are down? What if right before I'm ready to cash in a year's worth of stocks for my first year, stocks have fallen 30%? That's okay, because you know what you're going to do when you cash in those stocks? Let's say it's $40,000, just to make up a number. You're going to go into your 403B and you're going to take that $40,000 that you have sitting there in cash and you're going to invest it in your stock ETF inside your 403b. Remember, money's fungible. So we can pull money out of stocks in a taxable account and then readjust our asset allocation by going into, in this case, the 403b, taking that cash that you had set aside and putting it into stocks. Now, you do have to think about the tax consequences of selling shares of, say, your stock ETF in a brokerage account. Presumably, hopefully it's long-term capital gains. And of course, it's only going to be on the gain portion of your sale, not your cost basis. So it should be, a tolerable, tax situation. But of course, maybe not. You need to evaluate that. Maybe you'll conclude, I don't know, that owning short-term treasury bills is preferable. But I think it's at least worth considering the fact that you can use this strategy. And, this applies to more than just brokerage accounts versus retirement accounts, traditional retirement accounts. You could also use this strategy with Roth accounts. So, for example, you may have in your Roth all stocks, and stocks may be down. And you say, well, look, I don't want to sell stocks, but I kind of want to take my distribution from the Roth because I don't want to trigger any more taxes. But I don't want to sell stocks, and all my fixed income is in a traditional retirement account. It's okay. Pull out what you want from your Roth. Let's say it's $40,000 again. So you sell $40,000 worth of VTI, let's say, your total U.S. stock ETF. And then you can go into your 403b or 401k or traditional IRA and take $40,000 out of a fixed income fund and put it right back into FTI or whatever your stock index fund is. And so you're net, you're not selling stocks. You've sold them from one account, but you've bought the same amount in another. And so you're not in the situation where you're selling in a down market. So that's a strategy that I think we can use, particularly when we want to effectively get the right tax consequence. And that requires perhaps sort of juggling multiple account types. So there you go. I think that should be a viable alternative for a lot of folks. Hopefully it helps you. So great questions as always. If you want to submit a question, just subscribe to the newsletter with the link below the video. It's free. It goes out every Sunday morning, and you can just hit reply and ask me your questions. I do read every email and appreciate all the great questions you've sent in. Of course, you can always leave comments below with any questions you have as well. And until next time, remember, the best thing money can buy is financial freedom.